Okay, why don't we call to order and get started? We have TV 79 with us today as our first, so welcome all. As we kick off the Town Pension and Police Board meeting with our first agenda item is a presentation from Boston Partners. Welcome.
Thank you.
Good to see you both.
Yeah.
Please go ahead. We've all received the materials, I think, so we should be ready to go with your portfolio.
Thanks. And I'll just make an introduction here. Kara Patty is the one who's behind the scenes doing all the work usually. She's front and center today as Liz Sheeran, who has typically come down here, just had her first child about a month ago. Mackenzie, a nice little girl, and so Kara's here. Taking the staff from her for today's meeting. So.
Yeah, well, she's home with a newborn and not getting much sleep, I'm sure.
Yeah, exactly.
Nice to meet you all in person. I'm sure we've exchanged emails over the years, but nice to meet you in person and nice to be here. So I'll start with a quick firm update, and then John will go through the portfolio. I know we did not have a meeting. We didn't meet with you in January. But we will start on page 1 of the presentation. So we were at about $88.6 billion in under management as of the end of March. That's up just a tad from the end of the year, or the start of the year, really just because of slight market uptick balanced by a small outflow at the firm level. So 88 to 88.6. From when we last saw you in September, we're up about 16 billion from about 71 billion. So again, strong Q4 market, and then continued small uptick in Q1. No accounts gained or lost in the strategy that you invested in, premium equity, and as at the end of the quarter, managed 11.2 billion. So firm is stable. Any questions there?
No.
Flipping over to the team, again, stable. Dulio, if you see on the left hand column of the blue box, Dulio continues to manage the strategy. No changes to the portfolio management team for you. And again, on the right, fundamental and quantitative research team, just one analyst on the quant side retired in the quarter, but no other changes. And we did have one trader depart again in the quarter, but that's it.
Have they both been replaced yet, or still?
Not yet, absorbed by the team so far, but Rex are out. Any questions on the team? Good. Flipping over to John for portfolio performance.
Okay. Hi, everyone. Page 4 is a page of a lot of different numbers, and I'll try to have you focus on the most important ones. For the quarter, the total fund return net of fees was about 1.04% compared to 1.95% for the most relevant benchmark, which would be 50% of the Russell 3000 value and 50% of the Bloomberg Barclays U.S. Aggregate Index, so the balanced benchmark of 50-50. You can see for the 1, 3, 5, 7, 10 since inception time periods, we're anywhere from 1% to 4% ahead of the benchmark during that time period. Since inception, we've added about 1.9% of excess return. And Eric, you asked me a good question the last meeting, which was how much of that is due to the fact that we've been overweight equities during that time period, and how much has it been due to the fact that we've been good stock selectors? And of that 1.9%, about 1.5% of that has been due to the fact that we've added value on the equity side. Our equity returns over that time period have been about 9.9% compared to about 7.4% for the benchmarks, who have outperformed by about 2.5% on the equity side, which equates to about 1.5% excess return on the equity side. And the fact that we've been overweight equities relative to fixed income during our 18-year relationship has added about 40 basis points of performance over that time period. Further down for the quarter, fixed income was a modest positive relative to the benchmark, about 3.2% return versus about 3% for the benchmark. And for the 1-year time period, about equal to the benchmark, while our equity returns have been, about, for the last year, about 1.8% ahead of the benchmark. And that was for the town. The police numbers are virtually identical. Same story, same returns. for the time period. We create clone portfolios for each portfolio, so there's no difference. The only difference would be maybe a cash flow difference here or there, but the returns are very similar. Page 6 will show that we're not always 60% overweight equities, or at the 60% percentile. We're now 55% equities here. As a reminder, your benchmark is 50-50. 55% equities would say that we're still overweight equities, but they look less attractive relative to a couple of quarters ago, and that's basically due to the fact that 3-month Treasury yields are now 5.2%. 2-year Treasury yields are about 4.2%, and 10-year Treasury yields are about 3.6%. So there's actually a return that you can get in the fixed income market, which had not been there for the previous 5 years or so. So that's tipping the scales a little bit more towards fixed income right now.
What's the cash? Is that just so you don't have to sort of sell the old to buy new if you see opportunities?
Yeah, we look at cash as being the equivalent of being on the fixed income side of the portfolio. Having a cash return today of 5% looks pretty attractive relative to investing in a 10-year bond yield at 3.5.
Makes sense, yeah.
Okay, so that's a red letter day for us, changing the equity allocation and the fixed income. We haven't done that in a while.
That's big news, right?
Everybody's doing that now.
Yeah, but the business has
first time.
changed.
Yeah.
Exactly. In fact, we talked to a lot of financial advisors
Really
out there.
long time. In a really long time.
And the financial advisors say that, folks aren't looking for fixed income mutual funds or equity mutual funds, they're looking for CDs. They just want to lock in their money for a 1-year CD at 5% and call it a day, no risk return. So we're getting into a different phase of the investment environment today. As we can see the OPEB trust as well, again, very similar returns, not as long a track record with the OPEB trust. They started in 2017, so we've just hit almost our 6-year anniversary there, and similar equity allocation and fixed income allocation. Page 9, probably, in my opinion, the most important page on in the whole presentation, which shows your beginning assets and your net cash flows over that time period and where you stand today. So for the town employee pension fund, you originally invested about $26 million with us. Over the 18-year period, you've taken out about $3.5 million for a net investment of about $22.5 million, and you now have $100 million. So you've made about 4.5 times your net investment from your original investment from 18 years ago. That's a pretty nice return. The police, on a net investment basis, there's not as much money in the police fund at $57 million, but they again started with about $23 million, have taken out about $21 million, so there's a net investment there of about $2 million, and that $2 million has grown to $57 million. So again, pretty nice cumulative returns. That's the important thing, is that the health of your pension plan for your beneficiaries. And we're glad to help you to participate in that. Page 10 gives you an idea of investment in equity. So between the police and the employees fund, you invested about $30 million with us back in 2005 when we started this relationship. And that $30 million, if it had not been touched and had not been, you have to use it for benefits, but if you just kept it there, that $30 million would have grown to about $162 million, over 5 times the original investment. If you had invested in the Russell 3000 Value Index Fund instead, you'd have about $108 million. So we've created about $54 million of excess return on that initial $30 million investment over that time period. Again, that's a theoretical number because money's come in and out, but just to give you an idea of the value that we've added for your beneficiaries. Any questions on the numbers?
You're going to do a little attribution on the performance?
Yeah.
Okay.
Page 11 shows you our philosophy and process here, which many of you folks have heard many times. Eric, you've only heard it once before. But we're trying to create equity portfolios with 3 attributes: low valuation, low PE ratios, high free cash flow yields. Historically, low valuation securities have outperformed high valuation securities. We're also looking for high quality companies with high and improving returns on invested capital. Those companies are getting better over time. Companies that are getting better over time outperform in the equity market over time. And then finally, we try to find companies with what we call improving business momentum, and that can take various shapes and forms, but think about that companies that we anticipate generating more free cash flow than the market anticipates them generating over the next 1 to 2 years. And then we want to partner with management teams that allocate that capital in a wise fashion. That's what distinguishes a good team from a bad team from a management standpoint. We want to see them investing in their own core businesses. That's where we're going to get our best returns. But not to overinvest in those businesses such that their returns on capital begin to roll over. We'd like to see companies pay down debt. We'd like to see them increase their dividends. We'd like to see them repurchase shares. Generally indifferent between share repurchase or a dividend increase, as long as that excess cash is being returned to shareholders. Any significant acquisition or investment in a business where we don't deem them to have a competitive advantage, our research analyst, who's an expert in that sector and industry, takes a real good look at that investment to make sure we're not being diluted over a multiple-year time period. A couple of quarters of dilution is fine, but a couple of years of dilution would probably encourage us to look for another idea for your portfolio. Our research analysts, they're 18-year veterans, been with Boston Partners for over 10 years on average, and are real experts in their sectors and industries. Really rely on them significantly for the position in your
The
portfolio.
analyst said what sector did he or she cover?
The analyst that left was a quantitative analyst.
Okay.
Yeah, and we had anticipated his retirement, so we kind of backfilled his responsibilities with some of the younger people, giving them some more opportunities for advancement. On page 12, you can see how those characteristics are present in your portfolio today. You can see in the valuation circle, the second ratio down, PEFY1, that's the PE ratio of the portfolio based upon expected 2024 earnings, so next year's earnings. The portfolio trades about 11.5 times earnings compared to 13.2 for the Russell 2000 value benchmark and about 17 times for the overall S&P 500 for the broader market. So certainly have a less expensive portfolio with a significantly higher free cash flow yield at 4%. At the same time, we're not sacrificing quality. Very high operating returns on assets and returns on equity on average in your portfolio relative to the benchmarks within the fundamental circle. And then business momentum, 81% of your holdings have met or exceeded earnings expectations in the most recent quarter. So again, those characteristics continue to be there today. On page 13, we can just look at the all-cap nature of this portfolio. So we're looking at the opportunity set of large-cap stocks, mid-cap stocks, and small-cap stocks for the portfolio. We evaluate about 3,500 companies on a weekly basis to try to find the best ideas for your portfolio. We do that quantitatively. That's where the quantitative aspect comes in. And then our analysts focus on the top 30% of that rank list that we create with the best combination of those characteristics that we're looking for. Today, as you can see, relative to history, the green line is mid-cap securities. They're looking the most attractive to us on a relative basis within the portfolio opportunity set. We have about 45% of the portfolio in mid-cap securities today, about 50% in large cap, and about the remainder, about 10% in small cap.
That screen, the quant screen, is basically the three circles. So
It's the three circles. For each of those characteristics, we have about five submodels that define each of those characteristics, and then we create an overall rank list with the best combination all the way down to the worst. The discipline here is we try to buy stocks ranked in the top 30%, but we do traditional fundamental analysis on those companies. So for every 10 stocks that successfully goes through the quantitative screen, about 1 or 2 ends up getting a buy recommendation from one of our analysts. So very important part of the process. And then if a stock that we own falls to the bottom 30% of the list, that would be an automatic review by the fundamental analyst to decide whether there's a fundamental reason to continue to hold that company, even though it no longer ranks well quantitatively. Okay, so that's just kind of part of our discipline as well. And then when the analyst recommends an idea, there needs to be 15% upside relative to the market when they do that. And if that stock price appreciates to within 5% of their price target, again, it's an automatic review by the analyst. They can decide to raise his or her price target if the fundamentals of the company have improved more than originally anticipated. If they keep it the same, then it's an indicator to the portfolio manager, Dulio Romalo, that this stock can potentially be used as a source of funds. So these are all guideposts, but the buy and sell decision is 100% Dulio's responsibility. That's how he gets compensated on an annual basis. And the analysts themselves get compensated on whether their recommendations work out or not within the portfolios. Okay. On page 14, we can see how we're currently positioned today. In the portfolio, upper left-hand corner, you can see the top 10 positions make up about 18% of the portfolio. This is a fairly diversified portfolio. We typically run this portfolio with 120 to 140 holdings. Today we have about 126 holdings. We very much believe in diversification. We would rather have more holdings rather than less holdings to create those characteristics that we're looking for, because we're trying to diversify away the company-specific risk on the portfolio. we're going to do a lot of work for you, but I can pretty much promise you, of our 126 holdings, we're going to have a handful of mistakes this year. It always happens. We try to avoid them, but we're not going to be prescient on all the future happenings. So we'd rather have more holdings so that we can kind of make up for the couple of bad apples in the portfolio. On the right-hand side, you can see how we're positioned today relative to the benchmark. Your portfolio would be the blue bar, the green bar would be the Russell 3000 value. If you look at the bottom part of the page, real estate and utilities are not represented in this portfolio, and a little higher up, consumer staples are barely represented in the portfolio. Those are areas that can provide some stability in the portfolio, which would be actually not a bad thing to have in this economic environment, as a lot of folks are expecting a more difficult economic environment 6 or 12 months from now compared to today. But to provide that stability in your portfolio, we want to do it at the right price. And utilities just look too expensive to us today relative to history. They typically have traded in 12 to 14 times earnings, and they're trading more like 17, 18 times earnings today. So not a good outcome for us. Consumer staples certainly have good fundamentals and high quality balance sheets, but they just look so much more expensive than healthcare stocks. We're getting that stability in your portfolio by buying pharmaceutical companies, health insurance companies, as well as some biotech companies as well in the portfolio.
Did you have REITs in the book last either year or last quarter or not?
I don't think we've had REITs in the book for about the last couple of years.
Completely been.
They're just, again, high dividend yield, which we like. There's nothing wrong with that, but we want to see some good fundamentals there, and particularly office REITs today. In fact, we've been talking to some of the office REIT companies, and can you reuse that office space and convert it to something else? Because there's so much work at home these days that folks that have 6 floors are going to re-up for three floors of leases, coming down, and they're trying to figure out, can we convert it to retail space? Can we convert it to apartment units? And in New York in particular, there are such stringent rules around whether you can convert an office building into a residential space. It's really difficult for them to be able to do that. They can't do it nearly as quickly as they'd like to, let's put it that way. Going to put further pressure on that business. So healthcare is one of the areas that we like in the portfolio. And then in addition to that, consumer discretionary. And this, again, a way for us to add value is not to read too many of the headlines that are out there. I think many of the economists have been talking about a recession for the last 12 months, and it hasn't happened yet. And some of the strongest stocks in our portfolio in the most recent quarter have been home builders, as well as Tempur Sealy, which makes mattresses. That they had gotten really beaten up in the second half of last year and bounced back nicely this year. You wouldn't think that this is the best time to be buying home builders, right? But it has been. And another really strong holding that we've had in the portfolio is Bookings.com, or Booking Holdings, which is Priceline.com. Yeah. And if anyone flies, I had to take a day trip to Dallas yesterday. There wasn't a seat open on the plane, and I had to pay $800 for my round trip ticket. And hotels. You try to get a hotel in New York lately, $400 or $500 a night for a Homewood Suites or something like that. That's not even, it's for, a 3-star hotel. So anyway, the travel industry is doing very well right now, even though if you're reading the headlines, you'd think that we might be in a recession right now, So we just focus on talking to our companies, seeing what they're seeing from their own business units and what opportunities they're seeing. Really, our economic outlook is the result of us talking to 1,000 companies a year and amalgamating that all up, and seeing some areas of weakness, some areas of strength, and not worrying or predicting when the weakness is going to come before it really actually happens. Any questions on the portfolio positioning?
No.
Okay. Page 15 and 16 just shows you the current holdings in the portfolio, color-coded by recent transactions. So a green diamond would be a new addition to the portfolio, an orange circle would be an eliminated position, and an up arrow and a down arrow would be adding to or trimming an existing position in the portfolio. Relatively low turnover in this portfolio.
Is it generally low turnover, or does it really depend on the market?
It's typically 20 to 40% per year. This past year was about 19%, so it was on the low end of that range that we typically see. We increased that turnover this quarter. We did have some exposure to some regional banks in the portfolio, and the story has really changed with regional banks. really on a couple of levels, but due to the fact that they have to pay more for the deposits. I think we've seen what happened with Silicon Valley Bank and First Republic, and you just can't get away with having zero rates on your deposits anymore. There's too many alternatives out there. Their net interest margins are going to be squeezed, their earnings are going to be hit a bit. We're also then worried about increased regulation, and then if we do get into a difficult economy a year or so from now, there's going to be some credit issues as well. So I think there's a couple of headwinds in front of the banks right now for a little bit. So we felt it was prudent to sell those positions in the portfolio.
Is that also that's the regional aspect, right? I mean,
Yeah.
Did you shift towards any of the big guys? Like
We've already owned the big
deposits?
guys, so they did get some deposits. I'd say of the big guys that reported, JP Morgan had the best results. And
Yeah.
I'd say Bank of America and Wells Fargo were pretty much in line as expected, with some, on the margin, worries a little bit about net interest margin in the future. It's going to hit those guys as well, because I have a Bank of America account, and I think I'm getting 30 basis points in my checking account. They're going to have to give me a little bit more if they want me to keep more money in there over time, compared to alternatives right now. And then another holding we had in the portfolio was Schwab, which is interesting. They make a lot of money off of their cash reserves, and they're started to see money come out of their accounts as well. They had a bit of a funding issue where they had to take on some loans to be able to get their liquidity. We sold out of the portfolio. It tends to be a little bit more expensive compared to your average financial stock because they're a great asset gatherer. There's no problem with that story. It's just their net interest margins going forward are going to be squeezed, and that's going to cause a
And to clarify,
reduction
you
in
sold
earnings.
out of that?
So
or-
we reduced that
Some
position.
shift, okay,
Yeah.
yeah.
And you got rid of some regionals.
Yeah, and we sold the regionals. Okay. Just some longer-term attribution figures on page 17 just shows how we've done over the last 15 years in up and down markets. Down markets, we've outperformed 61% of the time, up markets 57%, for an overall batting average of about 58%. Maybe not to be focused on if you're an NBA free throw shooter, but if you're in the investment business and you're right 58% of the time, you're doing pretty well relative to competition, and you can see that on page 18. This shows our ranking of the all-cap value managers over the last 15 years, and we can see that our returns rank in the 8th percentile. Our risk-adjusted returns information ratio puts us in the 1st percentile because we're creating excess returns by taking less risk than the average all-cap manager out there. And then that batting average that I referred to before puts us again in the 1st percentile of all-cap value managers. Let me talk a little bit about attribution for the quarter, Eric, and the best way to show that would be on page 23 in the presentation. So on page 23, you can see for the first quarter, we underperformed the benchmark by about 125 basis points. If you go down, it's really kind of 3 areas of omission for our portfolio. The first would be communication services, where we were underweight that sector. We were underweight that sector because we didn't own Meta Platforms. Meta Platforms was up 87% in the first quarter. It hurt the portfolio by over 85 basis points at one stock by not owning it. The benchmark owned it, we didn't, cost us 85 basis points, so that's more than half of the shortfall. Other areas of pressure on the portfolio was financials. We already talked about the regional banks and Charles Schwab, which had been our biggest position that had hurt us. So that hurt the portfolio, and as again, we've at least attempted to rectify that by reducing our exposure there. And then the last area would be healthcare, health insurers, which have been very strong stocks here the last couple of years. In the first quarter, we were very much kind of a reversal quarter, where the stocks that outperformed last year underperformed during the first quarter of this year. Stocks that underperformed, like Meta, outperformed in the first quarter of this year. It's just one of these, it feels like a short-term reversal to us. The health insurance stocks underperformed. There was some fear around Medicaid, Medicare reimbursement rates. The last day of the quarter, the rate came in a little bit better than was feared. The stocks have rallied since then, positions that we've held in the portfolio. But for the first quarter.
Over the longer term, the meta omission, so to speak, I don't know, like, you probably know this, like over the 3 or the 1, like it certainly it helped you for the 1, right?
Yeah, it certainly
In a big
helped us,
way.
yeah.
But like over the 3, I'm just wondering whether it.
Yeah, I would say in 2021, it hurt us. 2022, it helped us considerably, and then
Right.
so far in 2023, it's hurt us. So I'd say if you added it all together,
Yeah.
it was probably maybe 20 basis points it hurt
Either
us,
way.
something like that.
Okay.
Another thing is, Meta hasn't always been in the value benchmark. It's been in
I'm
the,
surprised it is.
right, and it only entered in the second half of 2021.
Okay, thank you.
But that's an unusual outlier that it would,
Right.
one stock would create that issue for us. And still one that, we've been in this business for a while, but this reminds me of 2001. If you remember in 2000, all the growth stocks went down. That was the internet bubble burst. In the second quarter and the fourth quarter of 2021, we saw rallies of growth stocks during those quarters, even though after that they just continued to go down. I think we're getting a little bit of that bounce, that kind of, I'll call it a fake bounce, and we're not too concerned about it going forward. We're not believers that the Fed's going to be cutting rates anytime soon. I think the folks who are investing and taking the bets on some of these rebound stocks, the stocks that the underperformers last year, are betting that the Fed's going to be cutting rates later this year, and they continue to tell everyone that they're keeping rates until inflation is under control, and inflation's not yet under control. So, and if that happens, I'd expect that reversal not to persist.
Do you guys have like a firm view on that?
No.
I know it's hard to do.
Yeah, it's, we're much better off focusing on relative valuation within the equity markets
Okay.
than we are in trying to pick the direction of the market, the direction of interest rates, or where inflation's going, or what's going to be happening with geopolitical events. That's not our skill. This business, it's if you try to take bets or investments in places where you don't have so much skill, it usually hurts you.
Yeah.
Page 25, just like we can wrap up on that page, and this just shows the current valuation of different portions of the U.S. market, with the green bar being where we are today. The blue bar is the 40-year history back to 1982 of where these stocks have traded historically. So if you look at large cap growth, for instance, those stocks are trading at 25.6 times earnings, the median of that group, compared to about 20.5 times. So those stocks look about 25% overvalued to us relative to history. Compare that to mid-cap value stocks, which I mentioned we were overweight mid-cap value within the portfolio. They're trading at about 9 times earnings, typically traded about 12 times earnings. They're looking about 30% undervalued to us relative to history. So, look, these are general numbers. They're not going to be exact, but I think the direction is right, where growth companies still look expensive to us relative to history, and the value stocks still look inexpensive to us relative to history. Any other questions? Anything else we can help you with today?
This is pretty random, but in those undervaluations, are there any mammoth value traps embedded in there that are permanent?
There could be within there. We try to avoid those value traps with that focus on business momentum. That's
Right.
why, if we own a company that disappoints 2 quarters in a row, it's certainly on our watch list if it stays in the portfolio. If it disappoints 3 quarters in a row, pretty much out of our portfolio. So
Right.
we don't end up with those kind of multi-year value traps like GE over the last 5 years or something like that, right? I'm sure that there are some value traps in there. What you have to do is look at the company's cash flow and what's happening with their revenue growth over time. And I'd say a value trap that the payment companies these days. I don't know if you're familiar with Global Payments and Fidelity National, but they do credit card transactions.
Okay.
And you've ever heard of a company called Square?
Yeah.
You ever take a cab and they put
Yeah.
your credit card in the Square thing? Well, they're kind of disintermediating the payment companies, and that's kind of comes directly out of the bank accounts, doesn't have to go through an intermediary.
Right.
That's a place where those payment companies look very inexpensive relative to history. They used to trade at 18 times earnings. They're trading at 11 times earnings today, but their business momentum is
The
weak,
business
and it looks like
disappeared.
they're going to continue to be weak going forward. So we try to avoid those issues when we can.
Just one brief comment on this page. This is
Sure.
more just presentation-wise. I don't know if you can add a quarter-over-quarter change. I don't think you make many changes. What, right?
Yeah.
A quarter-over change here, and then here, I don't know if you can smooth the line be a little easier to read and maybe just like average.
Okay.
Don't have to, it's just
let's- yeah,
something
let's work
constructed.
on that,
if you
yeah.
wanna keep
Shading,
that, yeah.
you could probably do a shading bar, so then you could see relative to the average where the endpoint's falling.
Right.
If it's a pain, you know.
Okay, no,
You
we'll work on
verbally
it, good
shared it,
suggestions.
But like visually, to
Yeah.
this point, yeah.
Yep, okay. We will make a note
And
of
along
that.
those lines, just with regard to sort of the changes, so your increase in healthcare and sort of the financials that you had talked about with the positioning of the portfolio, as you look forward, those are, you anticipate steady, increasing more, are like since the end of March, you know, where we are now today, and sort of you mentioned some of these things that were moving along. Are those the two sort of stable areas that you're looking at forward over the next quarter?
Yeah,
Yeah.
I would say healthcare is a certain area of stability in the portfolio.
Yeah. So that's probably the largest change since last quarter, just to get a sense.
Yeah, just, there hasn't been much change. What I can tell you verbally what we've changed. It's not gonna be visually for you. But when I look at the sectors themselves, we've been adding to communication services. So Activision, the video game company, they're, right now Microsoft is attempting to take them over, and they're getting fought by the Justice Department there. If the deal breaks apart, we think the company's worth more than where it's currently trading at. So we're, in fact, if Microsoft went after them today, they'd have to make a much higher bid for them. This is something that happened, like, the announcement was over 12 months ago. So we think there's a good opportunity there. If they get taken out, they're trading at about a 30% discount to the takeout value. If not, we think the company's in good shape going forward. We also added Tegna to the portfolio, which is a television broadcaster, which, talking about areas that could be a melting ice cube, right? But with the, when you look forward to 2024 elections, there's going to be, big political spend, a lot of political spend on television. These companies Tegna trades at, I think, 5 or 6 times earnings. Excellent free cash generator. Another company that has been taken over, $24 takeover price, has not been accepted by the Justice Department, and it's basically because the owner is a South Korean native, and they don't want a non-U.S. person to own a broadcaster in the U.S. There's nothing from business
new about
perspective.
that.
It's just they didn't want, and he's a U.S. citizen and everything. So I don't want to get involved. I don't know politics here, but it seemed odd to us that this acquisition would be allowed to go through just because he happens to be South Korean native. So anyway, there's a good opportunity there. I talked about the biggest sales were within the financial side, and then we added to our technology positions as well. Safer names like Cisco, we added in the portfolio, we added to that position, 3% dividend yield, accelerating revenue right now, which has been good, and then Microchip, which is a diversified semiconductor manufacturer. If you're familiar with Texas Instruments, it's similar to Texas Instruments, but on a smaller scale, growing faster, at a better valuation.
Can I ask you one last question about the financials, which is the thinking the deposit run, or is it more about their commercial real estate exposure? Or
That
both?
would be, I'd say that the real estate exposure would be kind of a second or third derivative. So when we look at today, right, we look at it and say, okay, maybe this deposit thing clears up a little bit.
Right, could be
And
temporary.
it settles down, right? But then when we look out over the next 6 to 12 months, what are we going to see? We're going to probably see some additional credit issues as the economy slows down, right? And we're also going to see loan growth slow down because they're going to be more reluctant to spend. So that's, or more reluctant to lend. So that's not going to be great for the banking industry. Like, how do you get multiple expansion based upon that? And then when we look out, say, 6 to 12 months, we're expecting increased regulation on the regional banks, which will just increase their costs. And again, it'll be, so it's kind of like a death of 1,000 cuts. It's hard to find that positive momentum, even though the valuations today look attractive. So that's one of those areas
All that
where
wind
you can
in
look
the
at
face
it,
that
yeah.
you're like-
You can look at it from a valuation standpoint and say, this is the time to buy it, but it's just, the timing doesn't look right to us from a business momentum standpoint.
Great. Any other questions? Paul, did you have any questions?
No, I don't. Thank you.
Okay, great. John, Kara, thank you so much.
Thank you.
Appreciate
Thank
the
you, guys.
update
Appreciate
as
it.
always.
Okay,
Great
thank you
time.
very
All
much,
the
appreciate
hard
it.
Thank you.
work
Thank you.
on
Oh, thank
behalf
you,
of the
yeah.
portfolio. Thank you. Safe
Have a great day, and good to
travels.
see everyone.
Thank you.
Thank you
Thank
very much.
Can we take this?
Yeah, absolutely.
Remember our homework assignment. Thank you. Thank you.
Wonderful. right, so just before we jump to the next item on the agenda, I know as a follow-up from the last meeting, well, we always get the universe comparisons for the equity. If you noticed in your packet, you also have some comparisons for the Morningstar category and percentile for our fixed income investments. So just to call that out, because I know we haven't, it's been a while since we looked at the fixed income portfolio, and just sort of with all of the changes in rates and everything, just want to make sure that we keep on our radar when and if active management starts to become something that it does add additional value, and whether that's something we want to discuss. So I want to draw attention to that here in the back of the presentation. Did anyone have any comments on it or any thoughts? We can certainly table it, but I just wanted to raise it maybe for future discussion around whether or not we're seeing any trend changes.
Category. So
It looks like
it's basically, you're like a top, if you just index it, you're a 3rd to 50th percentile, right?
Yeah, 50, yeah, exactly.
Which is, of course, an indictment of active management of fixed income, but,
Yes. Well, back when, Boston Partners used to manage the fixed income, they had fixed income business, just to give you some of the historical perspective, and so we had it actively managed. And then they got out of the fixed income business, and so to solve for the fixed income exposure, we wound up going to ETFs because the active management just hadn't really been paying off for the fees. And Boston Partners agreed to continue to manage the allocation in terms of asset allocation, which until recently had been pretty static. So again, that was a number of years ago, and given where rates are today and just sort of as things can evolve in the markets, it looks like, Eric, to your point, at this point in time, there hasn't been a dramatic shift in ETFs falling to the bottom of the universe. They're still right there, mid and above. But I do think it's helpful for us to just keep an eye on that to see if there's any shifts along the way. So. All right, so next up on our agenda are just a report on the quarterly expenditures. This is really more for informational purposes. Were there any questions on any of this? No? Okay. If not, then we will move on to item 4, which is 4 and 5 on the retirement and refund applications. Tony, this is where you shine for us always. And we had a number of them. I was curious if you had any feedback or
I was
comments.
able to match every one of them. I don't look at the less than 1 years, but anybody who has a calculation involved, and they all match, I can match the USI calcs.
Great. It looks like both will need to take action because we do have some for the police this quarter.
We do. 1.
Yep. What, oh, 2.
2, yeah.
Yep, 2.
Oh, we got Frank. Yep.
Okay. So if we start with the town, if there are no questions on, can I have a motion to approve? Eric
I
approves.
move.
Do I have a second? Tony, all in favor?
Aye.
Aye.
And then for the police, do we have a motion to approve for the police?
We do.
Kim, a
Motion.
second?
Second.
Brent, all in favor? Wonderful.
Aye.
Okay, great. So that moves us on to item 6, which is regarding the death audit process, which was a topic that came up last quarter that we, if I recall correctly, I believe we tabled it because we didn't have a quorum. Is that right?
We also didn't have the information on how much it would cost to do it quarterly.
Oh, do we have, oh, thank you. I was trying to recall exactly what, so do we have?
Yes, so they were charging us $500 to do a quarterly, to do a monthly death audit, but we have the ability to go back and retrieve up to 3 months of payments if we find out late that somebody passed. And so we asked them how much they would charge to do quarterly, and it would be the same $500 per quarter instead of $500 a month. So it's kind of a no-brainer to.
It's a no-brainer.
So
death audit
You
simply-
save 2/3.
Exactly, and there's no danger of
And you can
missing
claw
something
back.
that you can't fix.
Right,
Just making sure we're not paying benefits out after somebody's passed.
exactly, because
Right.
that, we had found that we weren't always
Yep.
informed, and so
It's a statewide
this
thing, I think,
allows
too.
us
Yeah,
to,
yeah.
yeah, exactly.
Okay.
Okay. So then, that is something we do need to approve and take action on, so we can move from going monthly to quarterly, okay? So do we have a motion to approve that?
For the
For the police, we have Kim. And do we have somebody for the
Sure.
town? Eric, wonderful. Do we have seconds for both Tony and Brent? All right, all in favor?
Aye.
Okay, wonderful. That's great, savings, we love that. Okay. Item 7 are the minutes. And we have a couple of minutes here. So we've got the October minutes from last year and then the first quarter minutes. Did anybody have any comments, any changes or questions regarding the minutes? No?
Yeah.
All good?
Yep.
Okay. All right, so then we just need a motion to approve. Kim for the police. Do we have, Brent seconds? All in favor for the police? Wonderful. And then for the
Aye.
town? And for the town, do we have a motion to approve? Tony? Okay, and all in favor?
Aye.
Aye.
Who was the second one?
I was, I think.
Yes.
I think you got in there.
Need buzzers.
Yeah.
All right. Now, do we have any other items? There are no other items on the agenda. So if that is it, then we will conclude, and we just need a motion to conclude.
It's
All right.
unanimous.
Kim and Eric. Kim for the police, Eric for the town. The seconds. May I have some seconds? Brent?
Mike,
Okay,
Mike,
Mike is the second to adjourn. Do we have a second to adjourn? Tony's a second to adjourn. And we're all adjourned.
Keep going. Excellent.
All right. Our next meeting is July 18th, I know, with the summer. So just let Karen know if, so we can make sure we have a quorum.
What's the next one?
July 18th, yeah.
I can
Paul,
already-
thank you.
I can already tell
Thank
you.
you.
I'm calling.
Take care, Paul.
Bye.
Thank you.
Aye.